Within PDFP, growth of consumer spending moderated, while investment in equipment and intangibles rebounded from weakness in the fourth quarter. Surveys of households and businesses, however, report a decline in sentiment over recent months and elevated uncertainty about the economic outlook, largely reflecting trade policy concerns. It remains to be seen how these developments might affect future spending and investment. In the labor market, conditions have remained solid. Payroll job gains averaged a moderate 124,000 per month in the first 5 months of the year. The unemployment rate at 4.2% in May remains low and has stayed in a narrow range for the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. The labor market is not a source of significant inflationary pressures. The strong labor market conditions in recent years have helped narrow long-standing disparities in employment and earnings across demographic groups. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE in prices rose 2.3% over the 12 months ending in May, and that, excluding the volatile food and energy categories, core PCE prices rose 2.6%. Near-term measures of inflation expectations have moved up over recent months, as reflected in both market and survey-based measures. Respondents to surveys of consumers, businesses, and professional forecasters point to tariffs as a driving factor. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. With the labor market at or near maximum employment and inflation remaining somewhat elevated, the Federal Open Market Committee has maintained the target range for the federal funds rate at 4.25% to 4.5% since the beginning of the year. We have also continued to reduce our holdings of Treasury and agency mortgage-backed securities, and beginning in April, further slowed the pace of this decline to facilitate a smooth transition to ample reserve balances. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Policy changes continue to evolve, and their effects on the economy remain uncertain. The effects of tariffs will depend, among other things, on their ultimate level. Expectations of that level, and thus of the related economic effects, reached a peak in April and have since declined. Even so, increases in tariffs this year are likely to push up prices and weigh on economic activity. The effects on inflation could be short-lived, reflecting a one-time shift in the price level. It is also possible that the inflationary effects could instead be more persistent. Avoiding that outcome will depend on the size of the tariff effects, on how long it takes for them to pass through fully into prices, and ultimately on keeping longer-term inflation expectations well anchored. The FOMC's obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. As we act to meet that obligation, we will balance our maximum employment and price stability mandates, keeping in mind that without price stability, we cannot achieve the long periods of strong labor market conditions that benefit all Americans. For the time being, we are well positioned to wait to learn more about the likely course of the economy before considering any adjustments to our policy rate. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Now, I'll be keeping us to a pretty strict 5 minutes, as we have a lot of senators who want to and deserve time with the chair of the Fed. So, Senator Reynolds, we'll start with you.
Thank you, Mr. Chairman, for the courtesy. Chairman Powell, first of all, let me just touch base on, I'm just curious, a couple of items almost of housekeeping nature. With regard to Wells Fargo, was that asset cap and removing it, that was a unanimous vote by all 7 Fed governors, as I recall?
Yes, it was.
Okay, thank you. I really appreciated the chairman bringing up the fact that you have identified reputational risk and have addressed it. I think that was a really important item for the Fed to do, following up on both the OCC and the FDIC's actions. As you know, past Fed materials like the Supervision and Regulation Report often embedded reputational risk within the management component of the CAMELS rating system without clear metrics or accountability. That kind of ambiguity can chill lawful activity and distract from your core mission, monitoring capital, liquidity, and operational resilience. Now that the Fed is moving toward a more objective and disciplined approach to supervision, how will you make sure that this change is fully implemented at the examiner level? And more broadly, what other regulatory updates can we expect?
So on following through on supervision, Vice Chair for Supervision Bowman actually brings an unusual background to this work, and that is that she's a former supervisor. So she speaks that language and relates to their work. And I think if anyone can have an effective relationship with them and work with them successfully, it would be Vice Chair for Supervision Bowman. So I'm confident about that. As we think about the things that are going on in the pipeline, so I would just point to a few things. Basel III Endgame. We're going to look at the rating system. We're going to be actually voting to put out for comment something on supplemental leverage ratio this afternoon. We're looking at our merger policy. Stress tests is a big thing, and there are a number of things that we're looking at that we've announced and we'll be moving to in time.
Thank you, sir. The payment of interest on reserves has become a central pillar of the Fed's post-crisis monetary policy framework. Since the transition away from the pre-2008 scarcity model, where reserves were tightly managed to influence the federal funds rate, the Fed has relied on an ample reserves regime using administered rates like interest on reserves to maintain control over the short-term rates. As of February 2025, nearly 19% of the $18 trillion in bank assets were effectively loans to the Federal Reserve earning interest. Given this structural shift, how feasible would it be for the Fed to return to a scarcity-based framework where reserves earn little or no interest? And if interest on reserves were eliminated, what would be the impact that would have on the Fed's ability to unwind its balance sheet and manage policy rates?
So we're in an ample reserve framework now, and that's a good thing. That's a result of the global financial crisis and the desire to have lots and lots of liquidity and large liquidity requirements for our largest banks in particular. So that's a good thing, and that enables banks to keep lending through stress and that kind of thing. If you were to want to go back to a scarce reserves, it would be a long and bumpy and volatile road. I wouldn't recommend that we undertake that road. It would not save any money. There's an illusion that it would save money. That is not the case. And it would also not make credit more available. This, in effect, I would say having a lot of liquidity in the system, which is what goes with ample reserves, make sure that banks will be able to continue to lend. So we think it works. And I think unwinding it is a policy choice which could be executed, but it would take years to execute and it would be challenging and quite volatile.
Thank you. I've just got about 35 seconds left or so, but I did want to touch on one item that the chairman mentioned it, and I think it's important. I know that you didn't mention it in your opening statement, but would you talk a little bit about just exactly what's going on with your building when you have that type of an overrun on the prices and you're talking about billions of dollars in costs? I think it's appropriate for you to be able to explain to the committee exactly what's going on. Would you take a few minutes, please, and explain what's going on with the value of that building and why the costs seem to be so exorbitant?
I'd be glad to if I can have that time. So
please.
Thank you for the letter we received late yesterday. We will provide a much more detailed response, but just generally, I would just say we do take seriously our responsibility as stewards of the public's money. And the other thing I would start with is no one in office wants to do a major renovation of a historic building during their term in office. You much prefer to leave that to your successors. And this is a great example why, let alone two historic buildings that needed a lot of work. But we decided to take it on because honestly, when I was the administrative governor before I became chair, I came to understand how badly the Eccles building really needed a serious renovation. It never had one. It was not really safe, and it was not waterproof and that kind of thing. So we took it on. I would start by, I would also say that the media reports that you accurately quoted, they're misleading and inaccurate in many, many respects. And I would just point to, there's no VPI dining room. There's no new marble. We took down the old marble, we're putting it back up. We'll have to use new marble where some of the old marble broke, but there's no new, there are no special elevators. They're old elevators that have been there. There are no new water features. There's no beehives, and there's no roof terrace gardens. Other than that, so all of the sort of inflammatory things that the media carried are either not in the current plan or just inaccurate. So, but notwithstanding that, the cost overruns are what they are. So let me just say on that.
Well, we're well over the 5-minute mark. I'm happy to give you time to talk about that. I'm happy that there are no beehives in there, but we're going to figure out what they are anyways. Senator Warren.
Thank you, Mr.
Thank you,
Chairman.
Mr. Chairman.
Thank you. So, Chair Powell, the Fed released its updated economic projections last week, and I appreciate your summary, but I want to look at the trend lines here. The Fed's outlook on inflation, the labor market, and GDP growth have all gotten worse. Compared to your economic projections in December, the latest numbers show that the Fed is now projecting higher inflation, from 2.5% in December now to 3.1%. Higher unemployment from 4.3% to 4.5%. Lower economic growth from 2.1% projected just 6 months ago to 1.4% that you're now projecting. Chair Powell, what has changed in the last 6 months that has caused the Fed to forecast substantially higher inflation, somewhat higher unemployment, and lower economic growth than you did in December?
So some of it is just taking signal from data reports that we've seen. Some of it is people working in the possible effects in the short term of tariffs. We have no view on the wisdom or the longer term effects of trade policy. It's not our job. And by the way, I should add, our forecasts are generally, and in this case, are very, very similar to what outside forecasts are.
I understand that. I'm just using you as the gold standard here. I know it's consistent. But you mentioned tariffs as one of the things that has changed over the last 6 months. You know, Donald Trump has become president and the economy has headed down. Not only does the Fed data now show slower growth and higher prices this year, it sees slower growth and higher prices over the next 2 years as well. And the Fed sees no longer-term boost to the economy or drop in inflation. In other words, no upside to Trump's chaotic tariff war or his other economic policies. So let's talk for just a minute about what's under the hood of the Fed's economic forecast. Chair Powell, I know a lot of different factors influence the trajectory of interest rates. Is one of those factors how quickly the federal debt grows relative to the growth in the economy?
Not directly, no. We don't look at that as a factor that helps us set monetary policy.
So you're not watching the ratio between the amount of the federal debt and the growth in the economy?
No.
How fast the debt is growing and how fast the economy is growing? I think I have quotes from you saying last year, quote, we don't need to pay the debt down. We don't need to balance the budget. We just need the economy to grow faster than the debt. Are you saying something different from that now?
No, when asked and pressed, I pretty much always say the same thing as my predecessors, which is that we're on an unsustainable path. I would not say, though, that we do, I will say this, we do not look at federal financial policy and deficits as something that affects our month-to-month monetary policy decisions.
I'm trying to get the overall projection of what happens in the economy. So, for example, I think you have made the point that if we spend on things like childcare that can boost labor participation and GDP, that may be a time when you offset the debt that you incur to do that. But if there aren't investments like that and we are simply running up the debt, what's the impact of increasing the national debt? So I understand that you don't comment on fiscal policy, but it does affect your job, which is keeping inflation under control and also maximizing employment. If certain policies would materially drive up the national debt and increase the debt to GDP ratio over time, could that make it more likely that we would see inflation, all else being equal?
I mean, theoretically, sure, fiscal policy can add to inflation, but that's, again, that's really not something we comment on. We try to stay away from fiscal policy.
I understand you don't comment on it, but I do appreciate your acknowledgement of the math here. You know, the Joint Committee on Taxation projects the one big, beautiful bill would increase federal deficits by $4.2 trillion. According to analysis by the Congressional Budget Office and the Yale Budget Lab, the bill raises the debt to GDP by 24 percentage points. It slows economic growth, it increases inflation, and it reduces real wages. So two of Trump's signature policies, his tariffs and his tax bill, will increase costs for American families. When America borrows money, it should be for investments that Americans need, like investments in childcare or housing or healthcare that would actually boost economic growth and lower costs. America should not take away healthcare from millions of people who need it and then borrow trillions of dollars just so that a handful of billionaires and giant corporations can get even richer. Thank you, Mr. Chairman.
Yes, ma'am. Chair, banks are facing a record number of regulations. Small community banks are especially burdened by compliance costs. Bank capital requirements should also be appropriately calibrated so banks are not forced to park capital on the sidelines, limiting access to capital for Americans and small businesses. I was pleased to see that the Fed is looking to reform the supplementary leverage ratio. The SLR is supposed to act as a backstop to risk-based capital requirements, but too often the SLR acts as a binding requirement for U.S. banks. Would you agree that adjusting the SLR would free up capital for banks to invest more in treasury markets and other low-risk assets that would be beneficial to families and businesses across the country?
I would agree, yes.
Do you agree with so Vice Chair Supervision Bowman recently acknowledged that regulators tend to review individual elements of the capital framework in isolation without considering whether proposed changes are sensible in the aggregate and contribute to a capital framework in which all components work together effectively? Do you agree with her assessment, and how are you looking at the capital framework holistically to ensure that the Fed is not stifling economic growth?
Well, we're looking at basically the two big pieces now are Basel III and the leverage ratio. And I'm pretty confident we'll move on both of those in the relatively near future. And they fit together, as we discussed. The leverage ratio was always supposed to be a backstop rather than the binding. We want risk-based capital to be the binding capital requirement. So that's how those two pieces work together.
And as you look at I hope a reintroduction of Basel III, if you're thinking about the bones of Basel III, obviously, over the last several years, we talked about this on Monday, we've heard the comment that the capital requirement was about right, although that capital requirement has been going up every year. And so as you look at Basel III coming back and hopefully being reintroduced and not just recalibrated, what do you forecast?
Well, we very much look forward to working with our colleagues at the OCC and the FDIC on Basel III endgame, and I would agree we're gonna take a fresh start at that. You know, the last proposal was actually well above Basel minimums. That's the thing. It was the ways in which it was gold-plated, as we say, rather than the Basel requirements, which were very significantly exceeded.
Just giving us an opportunity to go back to the spending at the Fed for the construction, and you said that the items that were listed are not happening. I will say that the National Capital Planning Commission website, ncpc.gov, anyone can take a look at it for themselves, not just looking or listening to the New York Post, not just the Wall Street Journal, but page 129 of the final plans reflected rooftop garden terraces the page 127 and 129 were where we found the ornate water features and final plans. The new elevators that dropped board members off at the VIP dining suite was page 37 of the final plans. The white marble was pages 40, 41, 65 of the final plans. I would welcome your staff coming in to walk my staff through what is happening there, as opposed to what we not have only read in the New York Post, not only in the Wall Street Journal, but also at the National Capital Planning Commission's website. So we would welcome that opportunity to have a.
Can I just quickly
Certainly.
say, some of those are just flatly misleading. The idea of elevators, it's the same elevator. It's been there since the building was built. So that's a mischaracterization. And some of those are no longer in the plans. They've, that's earlier. The plans have continued to evolve.
That was one of the questions I asked my staff before having the conversation with you in the preparation, and assuming that your response would be to refute some of the things that were happening, was to ask the question, well, since the articles came out in April, have the plans changed since April as a result of the media attention to it, or was that just never in the plan? I would just say that having an understanding, a clear understanding of what's going to be and when it changed would be helpful for us. I will note that having confidence in what we hear is incredibly important, and I would give you the opportunity to bring your team in and or send your team over so that we can have that conversation. That would be helpful.
Look forward to doing that. And if you'll allow me to say one more sentence, none of those things were the cost drivers. The real thing is what were the cost drivers that caused the spending to increase, and we have those too, but those are not the things that did that.
Well, I don't want to.
We look forward to the conversation.
I don't want to eat into Bernie Moreno's time because he's kind of cranky when I do. I would just suggest that when I hear that things are completely and wholly inaccurate, and then I hear that they weren't quite the way they were, those are two very different framings of the conversation. And I only read page 129, 127 through 129, page 37, page 40, 41, page 65, page 129, because I could be wrong without any question, but I don't want to be misled. That's different. Next would be Senator Reed.
Thank you very much, Mr. Chairman, and thank you, Chairman Powell. Many times you've been asked about the status of Fed independence from the president, his constant harangues about interest rate policy, et cetera. But over the past year, we've also seen judicial pressure on the Federal Reserve's independence. The Chevron case, which dramatically eliminated the deference to agency decision-making, also extended the statute of limitations on the Administrative Procedure Act. And there is a strong sense that they're about to overturn Humphrey's executor case, which will eliminate the independence of practically all agencies. What's your judgment on the cumulative effect of these judicial actions with respect to the Federal Reserve's ability to do its job?
I mean, the net effect of all of those will be to make courts substantially less deferential to agency decisions. And so that's just the new world we live in. We'll continue to do our jobs, and obviously we'll respect the law as it is. That is the way the law has been evolving, though.
But there is increasing pressure on the independence from the White House. And do you believe that if Humphrey's executor's case is decided in a way that gives the White House more additional authority, that'll be invoked against the Federal Reserve?
I'd rather not speculate, if I may, Senator.
That's quite all right. The U.S. dollar. I remember when the phrase was "sound as a dollar." That phrase is getting less used these days. In fact, Bloomberg reported last week that foreign companies are demanding to be paid not in U.S. dollars, but in euros or Chinese renminbi. First, what benefits does a strong dollar have for us, and how will we suffer if the dollar is no longer considered to be the currency of world record?
So there are enormous benefits to having the dollar be the most important reserve currency in the world. It remains such. and for very long standing and continuing reasons, which is, our rule of law, our democratic institutions, our commitment to price stability, our open capital markets. All of those things remain intact, and I think being the reserve currency doesn't last forever, but it's quite a durable equilibrium, and I suspect that we will be the world's reserve currency for a long time to come.
But you're seeing indications that confidence in our currency is eroding in some places. Is that those?
I wouldn't say that. I think it's this is a very fundamental kind of foundational aspect of the global financial system, is the role of the dollar. And markets move around. Markets are digesting information that's sometimes very challenging to digest. I'd be very reluctant to come to any longer run conclusions about things that fundamental this quickly.
Well, I would suggest, and I know you'll keep your eye on it going forward. One of the things you've made very clear is that income inequality and lower rates of upward economic mobility are two of our biggest challenges. And you've also indicated that this is probably beyond the ambit of the Fed in terms of dealing with this. These are more legislative issues. And I would concur. So I was disheartened to read a report from the Congressional Budget Office, which is an independent agency, that the recently House-passed reconciliation bill will take approximately $1,600 per year from the lowest income Americans and give approximately $12,000 to the wealthiest Americans. That seems to be directly contradictory to a society who's committed to raising the income and opportunities and increasing upward mobility. Do you think that's a fair estimate?
I don't know, and I'd be very reluctant to comment on the reconciliation bill, even indirectly.
Well, your wisdom and sagacity has preserved you, and I hope it continues to do so. I must commend you finally. By 2 or 3 years ago, everyone around here was predicting or guessing how deep the recession would be. And because of your leadership at the Fed and other policies, we've avoided a recession. In fact, until recently, we've been growing faster than every other economy in the year, and you deserve credit for that. Thank you.
Just reiterate my opening comments for those who may not have been here when I made the comments that Chair Powell has a hard out today. Therefore, I'm going to do my best to keep us at 5 minutes each. Senator Kennedy.
Thank you, Mr. Chairman. Thank you, Mr. Chairman. Mr. Chairman, did I understand you to say that the reconciliation bill is the most extraordinary legislation you've ever seen? Did I hear that correctly?
There may have been some lost in translation there.
I was a little late. Tell me what tell me what the bond market's telling you.
Bond market's fine now, functioning well. It's pricing, it's reacting to economic news. There's adequate liquidity. Rates have come down pretty significantly from where they were a couple months ago. So I think I think inflation expectations have come down a bit from April, and in general, the bond market is functioning well.
Okay. Explain to me why we have seen in the last few months weakness in the dollar.
That's a great question. And of course, the Treasury Department has the job is responsible for the role of the dollar. So I don't know. I think I would go back to the thought that markets have been digesting an unusually challenging set of circumstances, and have reacted the way they've reacted. The dollar's kind of stabilized now. In fact, it's moved back up here in the last couple of weeks a bit. There are plenty of people who are still writing that the dollar is still overvalued. We don't have a view on that, of course, but I wouldn't really have an opinion on exactly why it is where it is.
Well, clearly there's a lot of geopolitical risk right now, which would lead one to conclude, all things being equal, that people would would be flocking to the dollar, and it would be stronger.
Well, you have seen some of that here in the last few days, but again, I don't really have an official view I'd like to share on that. I think there are possible explanations, multiple possible explanations. Again, one of which is that some people still feel the dollar is highly valued.
Yeah.
But we'll see.
I want to talk for a few minutes about tariffs and inflation. What does history tell us about tariffs and its impact on inflation or deflation?
So the thing is, we've been through a long period in which tariffs were going down. Remember, since World War II, really, it's been a process of lowering tariffs globally. So there just isn't a lot of modern learning on that. I think people look at the incidence of tariffs during the president's first term, but those were like 1/6 the size of what's people are estimating now. And they do find some effects on inflation. But remember, in 2019, when those tariffs were put into place, the economy was slowing. We actually cut rates 3 times. Inflation was running at 1.5%. So it was a very different time. This is different. I think one of the reasons why it's so challenging is that there really isn't a modern precedent. Yeah. And I think we have to be humble about our estimates. And we are very open to the possibility that transmission through into inflation will be less than we think, or maybe more than we think, which is why we're in a position of wanting to take our time and make a smart decision as we see how this unfolds.
Well, obviously, the size of the tariffs makes a difference, does it not?
It does.
And we don't know yet the size of the tariffs.
We don't. And we don't have a view on any of the merits at all. That's not our job. Our job is inflation, as you know, and maximum employment.
Will it also matter? Let's assume that there is upward price pressure. Would it matter how much businesses decide to pass on versus just eat? Does that make sense?
Yes, that matters. That is what matters. The question is, who's going to pay for the tariffs? Originally, it's the importer, but it gets passed along through the distribution chain to some extent to the consumer. The ultimate question of it is how much of it does show up in inflation. And honestly, it's very hard to predict that in advance. So we're watching to see, what shows up in measured inflation.
If the president's trade negotiators pursue reciprocity, which I define as both sides reducing, in a quid pro quo, reducing tariffs and trade barriers as much as possible. Ideally, in a perfect world, we would end up with 2 sides with 0 tariffs and 0 trade barriers. Would that be inflationary?
No, not at all.
That would cause the economy to roar, wouldn't it?
I think it would be.
Yeah. Okay. Thank you, Mr. Chairman. I appreciate your endorsement, Mr. Chairman, of the reconciliation bill.
Senator Warner.
Thank you, Mr. Chairman. Funny, Senator Kennedy, I didn't interpret his comments that same way. I would also say that, one, thank you, and we echo what Senator Reid said, thank you for your independence and doing the job. End of the day, I think tariffs are a tax, and they're going to hit. They're going to hit, I think, starting next quarter. And again, I think the reciprocity argument, that would be a nice goal. I hope we can then explain to the Australians, who are a strong ally of us, who we have a free trade agreement, so we don't have tariffs, who we have a trade surplus with, who I'm hoping we're going to be able to build jointly submarines, why they, with all those things, still got whacked with a 10% tariff. Doesn't seem rational or logical to me. But let me get to, I've been very concerned about some of the Trump administration's, I think, mismanagement of the federal workforce. I can tell you some of the DOGE approach in the national security and intel world. Cuts are having dramatic effects. But today I want to mention something that, frankly, doesn't get a lot of attention, a very small entity, the Bureau of Labor Statistics. U.S. economic data, which has always been independent, it's really been viewed as the gold standard across the globe. And frankly, the BLS data often is the guidepost that investors use regularly. BLS helps us get information about cost of living increases, policy making for you guys. It's used to adjust payments on the roughly $2 trillion in Treasury bonds. The truth is that the BLS data shouldn't be degraded on any basis. Yet, the administration has so dramatically, and I hope my Republican colleagues will hear on this, cut back the staffing at BLS that the BLS has had to significantly cut back on the collection of critical price and inflation data. Normally, BLS staff, when you don't have all the data collected, will estimate about 10% of the inputs into the CPI. Now, with these cutbacks, they've had to estimate close to 30% of the data. That means faultier data. How can we grapple with this, and what does the undermining and staffing shortages at a BLS mean in terms of your ability at the Fed to do your job?
You know, we can still do our job. I would not want anyone to think that the data have deteriorated to a point where it's difficult for us to understand the economy as well as we can understand it, which is not perfectly. But the direction of travel is concerning. You know, the U.S. has been a leader globally in investing in how to measure the output of a modern economy, which is something that we've led the world in for a long time. And it really helps not just policymakers, but also businesses if we have accurate information about what's going on in the economy. You're making decisions based on that economy, not just the Fed, not just you, but private companies as well. So I think it's I think it's something we should continue to invest in. And I don't like to see any deterioration in the public data, which has been the gold standard. The BLS, Bureau of Labor Statistics, and others have really been the bedrock that people really do look to as solid data that tell us what's
and these
happening
people
in the economy.
who do collect this input, who do some of this analysis, they are experts. They are not fungible. You fired one and hire another. I mean, there's an expertise here that has been, I think, being undermined. And again, you just look at the fact that if you have to do your estimates, move it from about 10% estimate to a 30% estimate, that is not good for the markets. Let me move to one other topic in my last minute. Stress tests, really important. Those of us who are significant banks.